This is Macro Horizons, episode 343. Let's see ADP, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of September 29th. As the government shutdown threatens to disrupt the flow of economic data, to say nothing of TSA and air travel, we take solace in the fact that we'll always have ADP. Of all the data joints in all the world. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market bear flattened, and to a large extent, that was more about messaging from monetary policymakers as opposed to the economic data itself. That being said, we did see an upward revision to second quarter GDP, which included a boost to consumption, leaving the second quarter at 3.8% in terms of real growth. Durable goods also surprised on the upside, all of which brings into question whether or not the Fed will choose to lower monetary policy by 25 basis points when it meets again in October. It is worth making the observation that 350 in two-year yields is definitively a line in the sand, and until the market more seriously considers the possibility of the Fed needing to cut below the neutral rate of 3% as defined by the FOMC, then we expect that the front end of the curve will continue to bounce up against that particular resistance level. Similarly, in the 10-year sector, we've seen a pretty significant backup in rates, but overall as a theme, the Treasury market remains in a relatively tight range between 4% 10s and let's call it 425. We are anticipating an extended period of consolidation as the market awaits the incoming employment data. We did have a lower than expected initial jobless claims in the week just past, which highlights the potential for the resumption of the resilience narrative in the labor market. There is clearly an open question as to whether or not the employment landscape will improve into the end of the year, and ultimately, we anticipate that this will define the direction of monetary policy over the next two meetings. That being said, the direction of travel for policy rates is clearly lower, and it's more a question of what cadence does the Fed want to set for normalization. Does the Fed want to risk being locked into 25 basis point cuts per meeting, or is a quarterly cadence of 25 basis points more in keeping with the Fed's view of the balance of risks for the real economy? Investors will be looking towards the combination of ADP and NFP, as well as the unemployment rate, for greater context for the inputs into the Fed's decision-making. We also had the final coupon auctions of the month of September, where we saw the 2-year performed well, stopping through 0.2 of a basis point, while the 5 and 7-year both tailed at 0.3 and 0.5 respectively. While there was nothing in the detail of the auctions to imply that there was anything other than consistent, ongoing support for treasuries as an asset class, the auction results did, at least on the margin, help the upward trajectory of treasury yields. Let us not forget that we had the August core PCE print, which came in, as expected, at 0.2%, and as such confirms the relatively benign inflation reads seen in September.
It was a week in the Treasury market that wasn't necessarily defined by the economic data. After all, the highlight was Friday's core PCE print that was in line with expectations, and really the more market-moving event was actually Thursday's data. Upward GDP revisions, lower than expected jobless claims, and a solid look at durable goods orders accelerated what had been this week's, and frankly late last week's trend, which has been a steady grind toward higher 10-year yields after 4% was challenged twice and definitively rejected, with 10s reaching back within striking distance of 420, and the yield curve continuing to press flatter with 530s dropping below 100 basis points for the first time since August 1st. Clearly, there remains a positional component at play in terms of driving the shape of the curve, and the fact that it was a relatively quiet week in terms of fundamental updates that netted to a bear flattening, our collective takeaway with Powell and others' comments from the Fed post-meeting, and the aggregate of the data was that heading into the end of the third quarter, this week's trading was more about positional alignment than anything truly game-changing in terms of the macro narrative.
And as the October rate cut or pause decision remains a key open question, it is notable that the market, to a large extent, is pricing in a reasonably optimistic next several quarters. By this, we simply mean a slow and steady reduction of policy rates combined with consumption continuing at a solid pace and the employment market perhaps cooling, but certainly not shifting into a point of major contraction. What strikes us when looking at the futures curve for 2026 that has Fed funds bottoming at 3% is that is perhaps the least likely outcome. We will either see an acceleration to the downside or a more material rebound, which will prevent the Fed from cutting further. None of this will be decided in the very near term. Instead, the market will look to the update from the BLS as well as ADP as it pertains to the overall trajectory of the labor market. As we've gathered, there are essentially two camps in the market at the moment. One camp believes that payrolls growth has bottomed over the summer, and between now and the end of the year, we'll see a steady climb back towards a normal pace. This outlook was reinforced by the lower-than-expected weekly jobless claims, as well as the upward revisions to consumption in the second quarter. On the other hand, there is a relatively compelling argument that hiring momentum has gone from resilient to stall speed, and the next move in the pendulum should be towards contraction. At the end of the day, we'll argue that the camp looking for a rebound in jobs growth is assuming that business leaders have moved on from the uncertainty that has plagued the real economy since Liberation Day. As a counterpoint, while the market has clearly moved on and is trading to what's next, which will be the outlook for 2026 and who's going to replace Powell, firms might not yet have sufficient clarity to start rehiring, and instead, we're somewhat nervous that there might yet be downside to be realized on payrolls growth. Obviously, the market will be looking at ADP as an initial read on the employment landscape as we look forward to the official, to-be-revised BLS data on Friday.
And it's that dichotomy and dueling narrative that defined the Fed speak we heard this week as well. Obviously, Governor Miron was vocal in defending his dissent last week, but we also heard from Bostic, from Hammack, and from Powell, who added greater clarity around his personal views, not those of the committee, as it relates to the balance of risks around the dual mandate. And it comes down to exactly what you said, Ian. It's balancing the upside risks to inflation, partially as a function of tariffs, but even the Fed has acknowledged that that impulse has been tamer than initially feared, combined with the fact that, yes, the labor market is cooling, but to look at the departure point in terms of outright growth and consumption, with this week's GDP revisions the latest example, it's not exactly as if this downshift in the outlook is taking place from an already shaky departure point. The economy was in pretty good shape during the first half of the year. It's weighing those upside risks to growth and inflation against this idea that a labor market slowdown hardly ever takes place in slow and orderly fashion that represents the split between the hawks and the doves at the moment. The characterization of last week's cut as a risk management one certainly leaves open the potential for October to be skipped, and while it's probably too soon for that to be a base case, in the event we see firmer hiring data or troubling reads on the consumer price front, it's not out of the question that the Fed will talk the market back into a quarterly cut assumption path going forward, as opposed to the every meeting one that's currently in the market. Again, given what we've seen in terms of the jobs data, especially the benchmark revisions, and what we saw in terms of the SEP, it's probably too soon for that to be a base case, but there's at least a reasonable probability and something to look out for over the balance of the year.
It also really comes down to the employment data at this point. The market and the Fed seem to be content with the overall trajectory of inflation, and while we'll argue that there is still pass-through yet to be realized from the trade war and higher tariffs into core goods ex autos, the reality is that the first 4 months of the trade war didn't see a material spike in realized inflation, and therefore the operating assumption has become that instead of condensed to the very beginning of the trade war, the higher tariffs will be passed through over a larger window of time. Whether that ends up being 8, 12, or 18 months remains to be seen, but ultimately, because it wasn't concentrated in the very beginning, the Fed has been afforded the opportunity to respond to the softer employment outlook, and therefore we expect that that will drive the October rate cut conversation. It is notable that at the beginning of the trade war, recall that Besant made a case for gradually phasing in tariffs over the course of an extended period of time. Now, in light of the Liberation Day revelations, it is clear that Trump did not agree with the slow, gradual increase in tariffs and instead initially erred on the side of simply starting tariffs at what was believed to be an endpoint. In practical terms, however, the combination of pauses, delays, carve-outs, and the general uncertainty related to the new tariff structure has led to a more gradual implementation. From one perspective, that's probably a net positive for the consumer and the real economy. However, it certainly complicates the Fed's job because rather than looking at 3 or 4 months of higher goods inflation as a one-time temporary price adjustment that monetary policymakers can effectively look through, instead we have the potential for sticky core goods inflation for the foreseeable future. Now, in a more typical environment, the Fed could err on the side of agreeing with Powell and concluding that a slower pace back to neutral is warranted. One additional complicating factor is the administration's shift in immigration policy. The changes made in Washington risk creating scarcity for low-wage, low-skilled workers, and therefore will be very closely following the trend in average hourly earnings. The obvious risk here is that immigration reform drives nominal wages higher at a moment where tariff pass-through has made the inflation complex stickier, and it ostensibly appears that there is a wage inflation spiral, when in fact, it's simply the real economy adjusting to the changes coming out of Washington. If nothing else, the balance of 2025 will certainly be interesting, if not macro redefining.
And it's somewhat ironic that we find ourselves talking about the supply side of the equation at the end of 2025, given that the supply side of the Treasury issuance landscape was the primary topic discussed to start this year. The question as it relates to how changing policy in Washington is going to impact labor supply will also necessitate some acknowledgement from the Fed in terms of assessing what the reaction function may or may not be to the type of wage growth that results from there simply being less workers to fill the same number of available jobs. While the root cause could not be more different, it's a not entirely dissimilar dynamic to what we saw in terms of the labor market coming out of COVID, where the combination of monetary and fiscal stimulus kept workers on the sidelines for far longer than was initially assumed to be the case. And we have a very clear answer on what the lack of labor supply did to wages in that case, and obviously the hiking campaign that followed from the Fed's perspective. Now, this variety of potential labor scarcity will hardly be on the same scale of what we saw around 2021, but as has been thematic throughout the case of the new administration, as we get more information around what new trade policies, what new immigration policies, what new fiscal policies ultimately mean in terms of the performance of the realized economy, it's going to be up to the Fed to respond appropriately to what is unquestionably a new paradigm in terms of economic policy out of DC. And that doesn't even take into account the challenges of forecasting economic performance with all the questions around data quality and the potential changes in terms of actual data collection of agencies like the BLS, but it's probably not unrealistic to say that Powell will probably be ready for his retirement party when the time comes.
Who knows? Maybe his retirement will be transitory.
Is that like a repo?
More like a SOFR.
I thought it was TGCR.
That's just a joke too far.
Remember, don't do repo.
In the week ahead, the Treasury market will have several key macro events to help define trading direction. Arguably, the most relevant will be Friday's payrolls print, where the market is looking for September to have added 43,000 jobs to headline payrolls. The unemployment rate is seen unchanged at 4.3%. Within the data series, we'll also be focused on average hourly earnings, where the market is looking for a 0.3% monthly gain. At the moment, there's a reasonable amount of uncertainty as to whether or not that we see a government shutdown at the beginning of October. In the event of a government shutdown, we think that it's still likely that we see the payrolls release on Friday, given that the data has already been collected and the vast majority of calculations will be completed midweek. Even in the relatively unlikely event that the BLS employment report is delayed, investors will still have the benefit of Wednesday morning's release of ADP. The consensus for ADP is an increase of 48,000, very consistent with expectations for the BLS official data. Tuesday also sees quarter end and month end, and all else being equal, we would expect duration to perform well into the close and provide something of a stabilizing bid. It's important to keep in mind that there are no coupon auctions in the week ahead, which will afford investors the opportunity to trade off of the macro fundamentals with, of course, the omnipresent risk of headlines out of Washington that could serve to help further redefine the market's understanding of the global macro landscape. Investors will also be tracking the JOLTS figures for August, as well as consumer confidence figures, and of course, the ISM series. Both manufacturing and services, although keep in mind that services ISM is released Friday morning after payrolls, assuming, of course, that payrolls is released. The market has shifted into a unique environment given the criticisms levied against the BLS and the data quality concerns there, in which private economic data, namely ADP and ISM, are gaining more prominence and therefore tradability at the moment. If nothing else, a government shutdown in which the flow of economic data is disrupted or delayed will put even more emphasis on the private data reports. After all, it's all the fundamental information that the market would have in such an eventuality. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as September 30th quickly approaches, all we can say is that it's the end of the quarter as we know it, and bonds feel fine. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.